So for a closer look at how to play or avoid this momentum trade, joining us now is Dory Wiley, Commerce Street Capital President. Dory, it is good to see you. I don't know if you were listening, Dory, to this conversation I was having with Julie here. We were just kind of talking about this, the kind of broader investing environment we find ourselves here in Dory. We look at these moves, Nvidia, the broader kind of AI mania we're seeing, and of course Bitcoin rallying. And just, I would love, Dory, just to get your take on what do you make of some of these moves? What do you make about the environment we find ourselves in?
Well, good beyond. And I was enjoying the conversation because I think we have a new mental mindset today that we haven't had for a while. Previously, recommending making sure you're allocated to the big seven or magnificent seven, X Tesla, overweight Nvidia. That's been working for us as a money manager. But now today, which is the conversation you're having, we know there's euphoria in Nvidia, right? We don't know how much, but there's a core reason to own Nvidia. It supplies all this AI to everyone. It makes money. It coins money. It has a massive margin, and everything's at light speed with accelerated computing and what they're doing in AI. And they're touching all the other Mag 7s. So, but there's something different today. Just something different. Bitcoin, that's a euphoria measure. Some of these other stocks, I was looking up SoundHound today. It's got a great technology and voice AI, but when you look at it, it's got a market cap of 1.8 billion, and it has 34 million in revenues. Well, immediately when you look at that, my mind goes back. This is .com-ish. I remember these kind of numbers in .com. How can I have a 1.8 billion market cap on 34 million of revenues? That's more euphoria than we have in fundamentals. Doesn't mean they don't have a great product, doesn't mean they don't have a great future, but surely that's a little ahead of itself. Doesn't even make money yet. And neither does another one, Bear AI, the same thing. Great product, great job in AI with logistics and with supply chains, getting themselves into the market, getting entrenched. But again, they don't have the revenues. They have a $525 million market cap with revenues $154 million. Not as bad as SoundHound, but still ahead of itself. And we're seeing this in the market today, a little more euphoria. And so the question I had for myself today was, is this the beginning of euphoria? Because I was okay with this tech rally because there were fundamental reasons for it. But now it's starting to feel euphoric. And how long can that go? If you remember, the Irrational Exuberance speech started in February of '96, and it took 4 years to pop the bubble.
I mean, it feels like it's been going here for a little while now, Dory, right? Certainly not 4 years, but, call it maybe 6 months. Maybe you can even date it back to when Nvidia first shocked the market last spring with its forecast. So I guess the question is, in this kind of a market, do you try and chase or participate or risk leaving out, not participating in the upside for some of these? Or how do you kind of play it in a smart way?
So what we've been doing is I think you under-allocate Mag 7 or Mag 6, X Tesla, because I can find fundamental reasons not to do that, at your own risk and very risk. I think you got to stay allocated, and I think you have to tilt to some of your favorites like Nvidia, and that's been working. But it's because there's fundamental reasons to do so. Microsoft, Nvidia, massive margins, massive market entrenchment, and great, return on equity. Estimated earnings, estimated revenues continue expanding. You saw for Nvidia what they did with their net income is up almost 586%. I mean, what kind of company gets you that? A company like that warrants a euphoria. So I'm okay with that. So I think you got to stay allocated there. And if it drops 20%, hallelujah. It'll shake off some of the euphoria, and you still got a really good company. I kind of hope that happens. I told my trader the other day, buy on the dips on Nvidia, and he goes, there are no dips. No, I said, no, a dip is when it goes up only 2% that day.
And Dory, I also wanted to get your take on, a big piece of economic data we're still waiting for, Dory. PCE on Thursday. We know that, of course, is Jay Powell's preferred inflation gauge. What are you looking for there, Dory, and how important do you think that is going to be for the market?
If it's a real material change, that'll be real important. I'm talking about to the downside or the upside. Know this: if you listen to Powell and Mickey Bowman, who I got a chance to interview the other day, and some others, they're very skeptical about the inflation data. They're very skeptical about the unemployment data. So I don't think you'll see them knee-jerk anything right now and changing their statements from beyond, a possible rate cut in May, more likely later in the year of some of the Fed speak that's come out this week. I don't expect that to deviate a whole lot. And if the number is pretty close to expected, then nothing changes.
And sort of what's the feeling, the consensus has seemed to come around to that the economy is going to be pretty good this year, that we're going to see pretty strong GDP growth, especially relative to what expectations were. Is that how you're viewing this as well? And then again, how does that feed through to the market?
I think we have to balance that with the market expectations. Absolutely. So the market is trying to balance this AI rally, if you will, with the expectation of rate cuts. Where I think the market's been making a mistake, and has been for the last 20 months now, is we don't have to have rate cuts to do okay. We don't have to have them. So it's almost like weaning the market off the bottle. We pull the bottle away, the market's got to grow up. The economy's going to be fine. Having 5%, 5.25% Fed fund, that's okay. People can handle that. We've had that for years. If you remember 20, 30 years ago, all passbook savings and now accounts all paid 5%. So that is okay. The market can do very well with with rates not cutting at all. We don't have to have the rate cuts. And I think that's where the market's been missing it.